Good evening. I'm Mike Knetter, and welcome to the UW Now, where we bring you timely and important topics covered by UW experts. The Federal Reserve has been raising interest rates at an unprecedented pace to help bring inflation back to its 2% target level. Inflation peaked in June at 9% and has since dropped to 6%, but that's still well above the 2% target. And this pace of interest rate hikes that the Fed has been on has now caused profitability problems in the banking sector, most acutely seen in the failure of Silicon Valley Bank and then the forced merger of Credit Suisse with UBS. Can inflation be brought under control without provoking a banking crisis and a full-blown recession? Tonight, we'll discuss the outlook for inflation, interest rates, and economic activity with the distinguished panel of UW experts. We have Dana Peterson, the chief economist at the Conference Board, Mike Stohler, the chief investment officer of the UW Foundation, and Brad Tank, chief investment officer and managing director of Neuberger Berman Funds. Kicking things off tonight is Dana Peterson. Dana is noted as chief economist and center leader of economy, strategy, and finance at the Conference Board, which is a nonprofit business membership and research organization. In her work, she analyzes global economic themes having a direct impact on financial markets, including monetary and fiscal policy, environmental, social, and governance investing, and demographics, among other things. Peterson's research has been featured by major U.S. and international print and broadcast news outlets on a regular basis. Previously, she worked as a global economist for Citibank and at the Federal Reserve Board, two positions which seem like ideal preparation to assess the current dilemma facing the Fed as it relates to the banking system and inflation in the economy. So Dana, thanks for joining us. Please, the floor is yours.
Mike, thanks so much for the great introduction and always inviting me to come. So yes, I'd like to talk a little bit about how we got here and where we're headed in terms of the U.S. economy. So how did we get here? Essentially, we've had a series of shocks, black swans and gray swans over the last 3 years, including the pandemic, which I would call like a black swan, which is something that you just can't possibly imagine. But when it occurs, it has a huge impact. And that caused a global shutdown, volatility in energy markets, and massive supply chain disruptions. And then we had a gray swan, which is the war in Ukraine. And essentially, a gray swan is a low probability event that's imaginable. But if it happens, then it has a huge impact. And certainly, we've seen the war cause not only a humanitarian crisis, but we've seen embargoes on energy and also massive supply chain disruptions in food, energy, metals and rare earths, chemicals and fertilizers, things that go into our food supply, into creating microchips, and also into creating batteries, which are needed for the energy transition. And this consecutive, uh, these consecutive shocks have caused rampant inflation, not only around the world, but especially in the US. At first, it was in commodities, transportation, where you couldn't find tankers to move product. And then once you move the product to the US, there was no one to offload it and there was no one to drive the truck. But that's shifted over. That's moderated somewhat, but we also saw massive demand for goods as people were shut out from experiencing services, especially experiential services like travel, hotels, and restaurants. And we also saw housing activity spike during the pandemic because interest rates were just so low. Now we're seeing a shift away from that. The housing market is coming off pretty dramatically in terms of sales and also prices because interest rates have been increased by 500 basis points in just the span of a year. And consumers are getting out of the house and they're engaging in experiential services like entertainment, restaurants, travel, hotels, movies, all those great and awesome things. That's what consumers are enjoying right now. But at the same time, we're seeing very tight labor markets. And labor markets are tight mainly because we have labor shortages. And the labor shortages are a function of an aging population. So, on top of the strong demand for services, wages are rising because businesses are attempting to satisfy the strong demand for labor, but the limited supply because so many people are leaving the labor market. All that inflation that we're seeing has caused the Fed to raise interest rates very aggressively over a very short period of time. It's unusual for the Fed to raise rates this quickly in 1 year. Usually it takes 1 to 2 years before the Fed uh, gets to its terminal point. And with that, we think there definitely is going to be a recession in the US. It's going to be short, it's going to be shallow, but a recession nonetheless. So let's take a look at some pictures. Next slide, please. So the big story again is inflation. So if you're wondering what's causing inflation, this chart will tell you everything you need to know. So on the left-hand side, we have goods. On the right-hand side, we have services. On the good side, those yellow bars, those really big yellow bars, that's food, meaning groceries. And food prices are being influenced by the war in Ukraine because Ukraine and Russia are both big producers of grains, and food grains are determined on the pricing is determined on a global scale. And also fertilizer is a big thing that's produced out of that region, and that's being affected by the war. And then you also have the avian flu and floods and droughts. All those things are causing food prices to remain elevated. And then when we think about services, there are two chunks. The first piece is housing. And essentially, when you look at these inflation gauges, the housing measures are rents. So they're either actual rents or they're imputed rents. Imputed rents are essentially, if I own a home and I rented it out, what would I get for it? Right? And rents keep rising. And that's a reflection of what already happened in the housing market. So, yes, the housing market is slowing, but it takes about 18 months before the slowing in the housing market shows up in the consumer price indexes. And then the rest of the inflation that we're seeing in services is things like transportation, which includes airfares, hotels, restaurants, all these things that people have been missing out on, had been missing out on during the pandemic and now are engaging in. And so we have very high inflation. Next slide, please. And so, if you're wondering when home prices or the housing components of inflation are going to fall, well, we think that we'll probably start seeing some movement late spring, early summer, because already home price valuations have started to roll over. And you can see that in the navy blue line and the yellow and the blue lines, which are common measures of consumer inflation, should follow that. So, we're going to get some relief on the rents, but it's not clear when food prices are going to come off. And certainly consumers are continuing to spend on services, causing services pricing to be elevated. Next slide, please. Excuse me. So, what is the Fed doing, or what has it already done? Well, I mentioned the Fed has already raised interest rates, or the federal funds rate, and other rates that are pegged to it by 500 basis points or 5 percentage points. So, we can see that in the left hand chart. The navy blue line has just spiked. And usually it takes a few years to get to anywhere close to being done. And we think the Fed has two more interest rate hikes. The Fed says it has one more. Uh, a second form of tightening could be some restrictions on lending to businesses and consumers amid the banking crisis. But then the Fed's probably going to find a peak this year after one or two more hikes and not cut interest rates until sometime next year. And that's because inflation is still probably going to be pretty stubborn. You can see on the right hand side, these are our forecasts for when inflation is going to get back to the Fed's 2% target. And it's probably not going to get there until the end of next year. So if we get to the end of this year and inflation is still above 3%, it behooves the Fed to keep interest rates where they are at a very high level and not consider cutting interest rates until they really feel confident that they can get back to the 2% target. Next slide, please. So, this is our forecast for the US economy quarter by quarter. We think that we're probably going to see decent growth in the first quarter of this year. It's probably going to be closer to 2% rather than 1%. But we're going to have 3 quarters of negative GDP growth. And that's going to signify the brief and shallow recession we anticipate. So, you're probably wondering, well, why don't we have last year, first and second quarter in red? Well, we don't think the US was actually in a recession last year because if you stripped out ex- exports and imports and inventories, What was left is called domestic demand. That's what consumers, businesses, and governments spend, and that was positive. But we think over the next 3 quarters, what consumers, businesses, and government will spend together in aggregate will be negative, and that's going to cause negative GDP growth overall and constitute a recession. But you can see we get out of it as soon as next year. Next slide, please. So even though we're calling for a recession, we think the labor market is going to do fairly well throughout this. So you can see on the left-hand side where the unemployment rate is right now. It's 3.6%, and we think it's probably going to rise to around 4.5%. That is really mild in terms of weakness in the labor market, especially compared to the 13.5% unemployment rate we saw during the pandemic, and also the 10% unemployment rate we saw during the great financial crisis. And that's again because of these labor shortages. And you can get a visualization of what labor shortages look like in this chart on the right hand side. So if you go back to 1980 or even the early 2000s, you had 4.25 working people for each retired person. Now you just have 3 working people for each retired person. So you lost an entire person and a quarter. And then 10 years from now, you're going to be at just 2 people. And that's because the baby boomers are retiring, leaving the labor market, and there aren't enough young people to replace them. So that's going to keep demand for labor very high, even though the recession is going to be happening. But the thing is that we're not going to see a robust labor market throughout. The labor market's probably going to be bifurcated between winners and losers. Next slide, please. So, one way to get at this is looking at which sectors have the most job openings or vacancies. And really, the sectors on the left hand side have the most job vacancies. And those are also the sectors that are suffering from the greatest labor shortages. A lot of them, you have to show up to work, in person work, or it's thankless, or it's dirty, or it's a lot of work, or it's in the government sector where it's very difficult for them to raise wages. So that's why there's tremendous demand for workers in those sectors on the left hand side, but not enough workers. And you have all these job openings. On the far right of this graph, you can see that there are very few job openings, and a lot of those are sectors that are actually going to start laying off workers, or they've already started to. Next slide. And I put a little arrow next to information because that's where a lot of the tech jobs are. Next slide. So here we have a brand new measure we unleashed this morning. It was featured by CNN in the news, and this is our gauge of which industries are probably the most likely to let people go. And you can see information services, that's where a lot of the tech jobs are, but also transportation and warehousing, because that's linked to goods and people aren't purchasing goods, they're buying services. Construction, why? Interest rates are rising, people aren't buying houses, you don't need to construct homes. And then other things like repair, personal, and other services, that's highly discretionary, right? You might put off renovations to your house. And you can see that on the other end of the spectrum, industries that are in the green range, many of those have severe labor shortages, like accommodation and food services, that's hotels and restaurants, healthcare, right? Healthcare had the most job openings. So as you can see, this whole entire labor market is split into two, into industries that will continue to hire and industries that will either continue layoffs or start laying off soon. Next slide, please. So just 2, 3 quick things on the banking crisis. The good news is that it seems like it's being contained. So we didn't see much volatility in the stock market. Really, only the bank sector kind of tanked, but the rest of the stock market, non-financials, managed to do well, and the stock market is turning upward. Most of the volatility was in the bond market, and you can see that on the right-hand side with the MOVE index. And even that volatility, some of it's come off with all the emergency actions that have taken place. Next slide, please. While one measure of systemic stress in the financial sector is still quite elevated, that's on the left-hand side, it seems like it's starting to come off a bit. And when we look at all the lending that banks are doing at the Federal Reserve to remain liquid and solvent, it seems like that may have plateaued, right? So we have weeks worth of information. The first week, we saw a big spike. Second week, we saw an even bigger spike. But the third week is not too far from the second week. Um, and the next slide, and my final slide, shows essentially what's been happening in terms of market expectations in the wake of this banking crisis. And again, the banking crisis was serious, but it seems like it's being contained. And for the most part, financial markets seem like before the banking crisis, they were expecting the Fed to raise rates a few more times. And then after that, they changed their expectations. And now they're anticipating rate cuts at some point this year. But potentially the shock was about 25 basis points, right? And so the Fed even said additional tightening from banks not lending may be about 25 basis points. So I think this isn't going to be a huge deal for the US economy, even though for a few weeks it really was kind of a white knuckle nail biter type environment. Thanks.
Tour de force through the US economy. Really appreciate you sharing, especially the hot off the press job loss risk slide by sector. I'm sure we'll get some great questions for you in a few minutes. Our next guest tonight is Brad Tank, Chief Investment Officer and Managing Director of Neuberger Berman, as well as the Global Head of Fixed Income Multi-Sector Group at the firm. He's a member of their Operating, Investment Risk, and Asset Allocation Committees and the Investment Strategy Committee. Brad is an expert on macroeconomics and monetary policy, brings 38 years of industry experience in a variety of executive leadership positions and mutual fund management. He is a graduate of the storied Applied Securities Analysis program at the Wisconsin School of Business. Brad, tell us how it looks from your perspective with the Fed trying to engineer this soft landing and navigate now a potential little banking crisis.
Sure, Mike. Thanks. Thank you for the intro. And as I was listening to Dana, I was thinking that you asked two questions. Dana's answered both questions. I very much agree with her answers. So I could either, as many Badgers are probably doing, listening to this call, go get a beer and pass it on to Mike, or I could elaborate a little bit more. So I think I'll elaborate a little bit more, maybe fill in a few things from more of a markets perspective, and then wait about 45 minutes before I go get my beer. So with respect to the recession, the forecast that Dana has for the U.S. entering a recession sometime in the latter part of this year is a reasonable forecast. I think it's one that makes sense. We're starting to see signs of softness in many places already. We saw a job survey today called the JOLT survey, which is the first soft JOLT survey that we've seen in quite some time. The bond market got pretty enthusiastic about that. The stock market didn't like it so much, a sign of impending economic weakness. So the signs are starting to appear. And with or without the banking crisis that we've seen, I think these signs would be appearing anyhow. And as Dana said, the Fed suggests that the effects of this banking crisis amount to some amount of monetary tightening in terms of higher rates. And it certainly will hasten this process along as credit conditions have deteriorated, and I think will remain tight and get tighter in the months ahead. Speaking of the recession, we have to go back through time, because if we were getting together maybe a year ago, the forecast would have been pretty similar. U.S. is headed into a recession. Fed has started on a very aggressive tightening campaign. Of course, they were just getting going, but the forecast a year ago was that the recession would have happened already. We'd be in it in the first half of this year. So the question, that many have is, why hasn't it happened? What's taking so long? And if it hasn't happened yet, is it going to happen at all? And there are three big surprises that happened from really fall through the early part of this year that led to economic strength that frankly wasn't anticipated. One, and this is typical when you get into a period of aggressive tightening of monetary conditions, things break. You have unforeseen circumstances. And we saw that back in early March with the collapse of Silicon Valley Bank and Signature Bank. But the first big thing that really collapsed was in October of last year when the UK pension system had big problems due to aggressive tightening on the part of Bank of England. And the feeling was at that time, this was a crisis that may spread to other pension markets around the world, may have knock-on effects, and it wasn't going to go away quickly. In retrospect, it went away pretty quickly. And to some extent, solutions are still underway in the UK to improve their pension system. There were some real design flaws in that pension system that came home under this aggressive central bank policy. But in terms of knock-on effects and contagion, it was in fact over pretty quickly. Many people have forgotten about it. Unless you're a UK pensioner, you probably have. But the other big surprises were something that often surprises: weather. Weather in Europe was remarkably mild, and we didn't have the energy market tightness and acceleration in prices that were feared because of very, very mild weather in Europe. Mild weather that if you happen to be a Badger tuning in from overseas, well, it's the middle of the night. Good luck with your insomnia. But you didn't have much of a ski season in Europe. In contrast to you lucky Badgers that live in the Rockies, we've had an epic ski season here. But weather was a big deal. And the energy crisis that was feared in Europe meant that the European economy performed much better than anticipated and continues to do so through the first quarter. And then, of course, the last big economic surprise was China coming out of COVID lockdowns quicker and more aggressively than anticipated. Some of that had to do with the political cycle and the 5-year party confab. And some of it just had to do with what I would call the luck of the virus. The last most prevalent strain being not terribly deadly and allowed them to relax standards pretty quickly. And China is off to a much better than expected start economically this year and is expected to gain momentum as we move through the year, to the point where economic forecasters that follow China are moving their forecasts up. While we may not grow much at all here in the U.S. in 2023, China is expected to grow somewhere in the range of 4.5% to 6% in real terms, depending on who the forecaster is. So a little bit of a recap there on why this is taking so long, even though it's been forecasted for a while. And I don't think it changes any of the factors such as tight and getting tighter economic policy conditions, financial conditions, and a slowdown in hiring, which is just beginning to start to show up. And of course, some of the softness in the housing market that Dana also pointed to. It's just taking a little bit longer than expected. We also heard from Dana that the banking crisis, while drama for a few weeks, is not likely to turn into a full-blown crisis. And part of that is pretty straightforward. And it was in one of the charts that she showed with respect to how much money and how swiftly the regulators have come in to tackle this problem. And it emerged very quickly. It started on March 9th. And if you look at a timeline of events, really within a matter of days over the weekend, on Sunday, March 12th, the Fed, FDIC had basically cooked up a plan to backstop underwater security portfolios for the entire banking system. And one of the things that we saw during the COVID crisis in spring of 2020 is a lot of the policy tools and aggressive actions that central banks used post-global financial crisis, the so-called post-GFC playbook. They pull that playbook out, they add a few pages, and they play it faster every time. And that's, again, what we saw. As a matter of fact, our response to one of the root causes of the SVB problems, which was a large underwater bond portfolio, it's been known really for the better part of the last year. Bank analysts, people that follow the banking industry, if you're a banker, you know that this is a big problem in the industry. The swiftness which rates have gone up has meant that your bond portfolios have gone underwater pretty quickly. Because it was well known by regulators and bankers, And given the speed that they pulled this new tool out and applied it, they probably had it in their pocket prior. It's a very good guess because it's a big program, and it goes a long way toward ensuring that we're not going to have a full-blown banking crisis. Because if you look at the average bank in the United States, the losses in their bond portfolios are anywhere between 10 and 20% for most banks of total bank capital. So that's a meaningful number. And that includes a lot of healthy banks. It includes some of the big banks like Wells Fargo, if you were to mark their entire portfolios to market. In the case of an SVP or Signature Bank, the marks to markets were much worse. And hence, the magnitude of the problem was much greater. The other thing that we learned during this banking crisis, which changes the game for regulators going forward and continues to present ongoing problems or challenges for both regulators as well as investors and depositors in banks, is what about this notion of deposit insurance? We knew that in the case of these failed banks, SVB and Signature Bank, once the regulators took them over, they made all depositors whole with respect to their deposits, regardless of whether they were under or over the $250,000 minimum. And a bit controversial at the time. Deposit insurance that all financial institutions pay, in theory, is only supposed to cover depositors up to that 250 number. It, in all likelihood, requires a congressional action to change that, and that debate has started. That's part of a potential set of solutions to further strengthen the banking system in the United States. And it's, I tell you what, a year from now, if we get together, Congress won't have acted on it, but they'll still be talking about it. And in the meantime, the good news is the Fed, the FDIC, feels that between their new term funding facility for underwater bond portfolios and their demonstrated willingness and ability to backstop all depositors when they take over an institution, they think they've done enough. Time will tell if they've done enough. If you've got big deposits at a bank, do you really want to wait around until it fails and they're taken over by the regulators to make sure that you're 100% covered on your deposits? Well, a lot of people aren't waiting around, and that presents an ongoing problem or dilemma. So while, again, I very much concur with Dana that this is not going to turn into a large spread banking crisis akin to what we saw in the GFC back in 08, 09, and 10, it has created a set of problems that are going to linger for a while. So today, JP Morgan's chairman, Jamie Dimon, released his annual letter. It got a lot of attention. It often does. He's got some good insights in there. Typically, he said the after effects of what we've just gone through in the last month are going to linger for 2 years. So here's the one bank CEO that actually made it through the financial crisis, kept his job, and has continued to do a good job running his bank. And he thinks the knock-on effects are going to be around for a while. The problems that the markets and bankers and depositors will have to continue to concern themselves with, or this whole issue of small banks versus big banks. What do we know about the month of March? A lot of deposits either left the banking system and went into things like money funds, which was destabilizing, or went from small to mid-sized banks to big banks like JP Morgan, Citibank, Wells Fargo, and so on. The belief being they're too big to fail, but I'm not so sure about my community bank down the road. And so this small bank, big bank phenomenon is a fundamental concern, I think, economically and for the regulators, because what do we know about the small and mid-sized banks? One, there's a lot less of them today than there was even pre-GFC. The number of banks pre-GFC to today is down by almost 2/3. About 4,000 financial institutions. I remember when I took money in banking back at UW, I think there were 30,000 financial institutions in the United States. We wiped out a whole industry called the thrift industry. So it's been going that way for a long time. And the problem is when things continue to move in that direction, the availability of credit that comes from the small to mid-sized banks in small to mid-sized towns and in rural communities diminishes a lot. So that's a big ongoing concern. The other ongoing concern is deposit velocity. So Silicon Valley Bank lost $42 billion worth of deposits in a day. No one ever expected that. And that is a feature that is not going to go away. That's technology. We all know with a couple of points and clicks, you can move money around in and out of mutual funds, in and out of money funds, and yes, in and out of your deposit accounts. There's a story that got a lot of attention in the week after SVB from a banker who was sitting on a bus going to a tech banking conference in Big Sky, Montana. And he wondered why everybody was feverishly on their phone on that particular Friday, going from the Bozeman airport to Big Sky. And somebody said, we're all pulling our deposits from SVP, and they're all doing it on their smartphones. So this is a new phenomenon that the industry and the regulators, the velocity of deposits, it will be a challenge. And actions are being taken by individual banks. You're seeing them get more aggressive with respect to the rates on term deposits so they can lock in and improve the quality of their funding. But ultimately, more is going to have to be done. And then the last thing, which hasn't got a lot of attention and does play into the impact of a recession, is evident in SVB. So one of the hallmarks of a problem financial institution is it grows too fast. SVB grew like a weed for 2 years. It grew deposits at 10 times the industry average from COVID lockdown through the beginning of last year. 10 times the industry average. Deposits were up 220% over that period of time. The average bank had deposit growth of about 20%. That's certainly a sign that things might not be right. Most fortunately, over the short term, not so fortunate, most of those deposits went into a bond portfolio that's very much underwater, but a lot of it went into loans. And the reality is, if you look at the restructuring of SVB and the ultimate forced sale in First Citizens Bank shares, their loan portfolio, which peaked at about $72 billion, was effectively marked in half by the regulators. If you look at the haircut and if you look at the backstops and the guarantees. So that loan portfolio, in addition to the bond portfolio, also may prove to have some issues, and it will take a couple of years for it to work out. So why I say it's an ongoing issue or something to contend with is the market has now turned its attention, courtesy of this banking crisis, to other banks and financial institutions, and looking beyond deposit velocity, looking beyond high quality bond portfolios that simply are underwater because rates have gone up a lot. And they're looking at loan quality, and a lot of the attention is being paid to commercial real estate, particularly office properties. And one of the things that we know is commercial real estate in many cases is pretty prominent on the balance sheets of many financial institutions. And as someone who sits on an office on LaSalle Street and stares across the street at a $1.3 million empty office building, formerly Bank of America's headquarters in Chicago, commercial real estate's a huge problem, and it's a balance sheet problem, and it exists in a lot of places. And so I think one of the keys to Dana's forecast about the recession being short and shallow will be, to what extent are these balance sheet problems, which are lingering out there, going to surface and create even bigger problems, whether it's in bond portfolios, whether it's in the shadow banking world of private debt, private equity, or whether it's in commercial real estate, specifically office. Time will tell where that goes. So with that, I'll pause and turn it over to Mike.
Well, Brad, you've earned your beer. Feel free to grab one now. Stohler will give you a little break here, but thank you. That was really interesting to hear your take on the outlook and your general coherence with Dana's forecast, but maybe a few cautionary notes as well. Next up is Mike Stohler, who's the Chief Investment Officer at the UW Foundation. Previously, Mike served as Managing Director of Investments at Washington University in St. Louis. Prior to joining their shop, Stohler worked in multi-asset class portfolio management with JP Morgan Private Bank, headed, as Brad noted, by Jamie Dimon. Mike, began his career initially as a high school physics teacher, discovered that he didn't like high school boys as much as he thought, went on to get a PhD in physics at Purdue, and then eventually couldn't resist his lifelong love of investments and got an MBA at the Stern School of Business at NYU, and the rest is history. The Racine boy is finally back where he belongs in Madison, running our endowment. So, Mike, if you don't mind, why don't you tell us how all these circumstances look to you and what it means for our endowment investors? What are you doing with money these days?
Thanks, Mike. Good evening, everybody. It's nice to be back with the whole UW community, with my old friends Dana and Brad. And Brad started out by talking about how he mostly agreed with what Dana had to say. I'm in a tougher spot where I mostly agree with both of what Brad and Dana had to say. So I'll try to keep it pretty tight here. But before I go into the questions at hand, it's probably worth contextualizing the foundation's endowment and investment strategy a bit. As a reminder to everyone, the majority of the investment assets that we manage fund perpetual gifting to the university in support of students, faculty, research, and academic excellence. The extremely long time horizon allows the endowment to think pretty strategically about capital deployment and be less sensitive to market volatility, like the volatility we're living through right now. The way we structure and put discipline around the whole process is to maintain a strategic target for our asset allocation and make smaller adjustments to account for current market conditions. Sometimes that's for risk mitigation, and other times it's for opportunistic investing. As highlighted by Dana and Brad, the good news is that today's world looks very different than it did 18 months ago. The most important piece for me is that now both financial markets and the Fed seem to be paddling in the same direction. Wider credit spreads and tighter lending standards at banks are now, in effect, doing the work of the Fed, giving them room to play a less hawkish role. Consumers have also, at this point, felt the pinch. Consumer sentiment has been at some of the lowest levels in decades. And as Brad mentioned, the jobs data is now showing early signs of softening, which is something we were waiting for. The other piece of good news is that the swift actions of the FDIC and Fed, make it so that we're probably not facing a global banking crisis at this point that will further destabilize markets similar to what we saw in the 2007 to 2009 GFC or global financial crisis. Brad did mention some lingering knock-on effects. Like, will banks be run more conservatively for the foreseeable future? Will there be some kind of short-term negative wholesale deposit velocity? Will banks be subject to additional regulation and safeguards? Will an uptick in non-performing loans have real impacts on earnings? Brad mentioned commercial real estate in particular. The answers, of course, are yes. However, the real question is, does it lead to anything acutely worse? Big picture, banks today are much better capitalized than they were heading into the GFC, where the unwind of banking leverage sparked a cascade of negative knock-on effects. The aggregate loan-to-deposit ratio, for example, was 50% higher going into the last cycle. There are two main reasons that you could credit for better bank balance sheets. The first is regulatory, call it a success of the Dodd-Frank Act. It had a clear and positive impact with respect to keeping at least the largest banks significantly lower leverage levels. The second, ironically, was a significant influx of deposits going into COVID, partially fueled by stimulus. We, in terms of managing the endowment, continue to believe that equities are a reasonably good inflation hedge over the long term. After all, one person's costs are another person's revenues. Because the foundation has a very long time horizon and has a high cost of capital, we have 70 to 80% of the portfolio invested in public and private equities. Going forward, we don't expect to deviate from that equity orientation, even though fixed income will likely, once we get into real rate territory, be marginally more attractive. We do think there are some underlying investments that have become materially less attractive on a relative basis. At the highest level, marginally less attractive strategies are one where leverage was historically part of the return generation. Higher interest rates and tighter underwriting standards probably means more expensive and less available debt. Of course, this will first become an issue for asset classes with shorter or medium-term financing. So segments within the real estate market and corporate buyouts come to mind as spots that may face headwinds relative to the more recent past. Throughout the last year and a half, we opportunistically looked to lean into long-duration investments that we thought were going to be good entry points to buy durable assets to potentially hold over a market cycle or longer. The strong dollar also provided us with the ability to deploy capital at compelling valuations globally. And our pipeline at this point continues to center around identifying quality assets that are held by distressed sellers. So the assets are quality, but the sellers are not, including banks and other financial institutions where we think we might get paid a disproportionately high rate of return for providing liquidity to the market. And I guess, as they say, never let a good crisis go to waste. We feel good about the repositioning we've done within the last couple of years to upgrade our partnerships and underlying holdings. While we expect volatility to remain high for the foreseeable future, we think we've built a robust portfolio at this point to help us recapture upside and let investment quality and margin of safety resulting from attractive entry valuations protect us on the downside. So with that, Mike, I'll hand it back to you, I guess, for Q&A.
Great. Thank you, Mike. We had some great questions come in. I saw a few in the chat. Both Nancy Knorr and Steve Goldstein were wondering who is ultimately paying the tab for all of the backstopping that's going on. And I guess I would just say a little further, and maybe I'll start with you, Brad. How much can government regulation just continue to bail out mistakes that are made in the private sector and not really create an inordinate amount of moral hazard that really undermines what capitalism is supposed to be about?
Yeah, therein is the great dilemma, Mike. And I'd encourage everybody to look it up. It's about a week or so after the crisis hit, the great economic and political commentator Niall Ferguson wrote an op-ed in the Wall Street Journal. And Niall said, death, taxes, and bailouts. And he went on to basically describe, this is something that's become more or less a permanent feature. We've seen it happening with greater frequency, and we can expect it to continue to happen. In his words, he said, we now live in a time of latent financial fragility. And what that means is the invisible hand sometimes needs a very big helping hand. So one of the reasons why I like Niall is not only does he have some good insights, he writes really well and turns the phrase pretty well. So death, taxes, and bailouts, it's here. And, the reality is there's no way to get away from it. And he authored a much longer paper, which he referenced, more of an academic paper on the costs and benefits of bailouts. And the short conclusion is the benefits accrue over the short term. You avoid what we've just talked about, our general conclusion that we're going to avoid a major financial catastrophe or a banking system meltdown here because of this large helping hand. But over the long term, it is a bit more detrimental because you disincentivize good behavior. You incentivize bad behavior. You create moral hazard. People will take bigger risks if you know that you're backstopped, right? And that's effectively what happens. And so don't think there's any way to get away from it. The question is, what are the here? I think our challenge as market participants and forecasters are, how does it change our forecasting and our market opportunities over the short term? To some extent, it de-risks banks a bit, but it comes at the expense of impaired profitability, because as Mike said, the solutions that are just starting to be discussed include reevaluating deposit insurance, which will cost the industry more regulation, more capital. It'll lower the return on investment or increase the cost. So there are already economic implications for the bank. So answering your question of who pays for it, at the end of the day, the first line of defense are shareholders and bondholders in these banks. Curious thing happened with Credit Suisse. Shareholders got a little bit of money out of it, not a lot. $3 billion for one of the world's largest financial institutions is not a lot. That's the price UBS paid. But there was an entire class of bondholders, subordinated bondholders, that was completely wiped out. 17 billion in capital, completely wiped out. So your first line of defense is shareholders and bondholders. For depositors, you've got the FDIC and insurance. Ultimately, the Fed believes that the deposits guaranteed above 250 in the case of Signature Bank and SVP will ultimately be realized through these liquidations, and they'll probably not have to enlarge the insurance payments. But what we've seen in the past is when things get really catastrophic, as they did in the GFC, and as they did during the COVID crisis, which wasn't a financial crisis, but there was a large helping hand that came in the form of, at the end of the day, the taxpayers pay, and they have, and they will continue to pay.
Dana, Mike, anything to add to Brad's answer to that?
I think also what's risky about this episode is that you're seeing this concentration of banking. So I think Brad mentioned this earlier, and there's this really great chart. I created it, and then the next day I saw it in the Wall Street Journal. So I don't know if someone was looking over my shoulder, but you could see that small bank deposits were just collapsed overnight. And a lot of it was winding up in money markets. Some money markets are issued by other financial services, but some of them are issued by banks. But you also had flight to safety, where people were leaving small banks to go to larger banks, making them what I would call super SIFIs, right? And so, you're also going to see this credit crunch, especially for small businesses that rely on these small regional and medium-sized banks. And that's going to be a big negative, where they're not going to be able to gain access to capital because they can't go to the big banks. And if they do, the big banks are going to offer very vanilla types of lending, which certainly for the tech sector is not what they need. They need that more bespoke, complex lending options. So I think that in addition to the moral hazard concerns, you're seeing this consolidation of banking that I think is creating new and bigger risks.
So I want to follow.
I'll maybe add something controversial, Mike, which is I will say that I think the Fed is being incredibly cost effective in terms of how they're addressing this. And what I mean by that is they're addressing it in a way where they actually, beyond two examples, are not explicitly providing any additional guarantees. So they've thread this needle very carefully, where they've tried to make depositors feel confident in the banking system while not explicitly guaranteeing anything over $250K. That's incredibly cost efficient for them to do that, because the best thing they can do for society, for America, is to restore confidence in the banking system. And that's as cheap as it gets. And I thought they handled that narrative very well.
Great point. I want to push a little further. There's a couple things that have happened that start to lead me to wonder about the long-term future of, the dollar in global finance and fiat currency generally. Just the behavior that we're seeing where, the Fed seems to be ready to bail out any sign of problem. We don't want to possibly contemplate, anything like a Great Depression again. And then now with the rift in relations between the US, Russia, increasingly China, and many other large emerging countries being forced to kind of take sides in this whole situation. We see things like China and Brazil deciding to ditch the dollar for their trade transactions. I realize, there isn't at the moment a clear alternative to the dollar, and it's not going away as the world's reserve currency anytime soon. But, will it kind of be death by 1,000 cuts? And, are we creating an opening for cryptocurrency or other things that, aren't going to be debased every time there's a crisis and the Fed decides to bail out the American institutions affected by the crisis? That's effectively funded not just by American taxpayers, but everybody who's holding dollars. And that's a lot of people around the world. And how annoying is that if you're in a poor country, India or China, and you're bailing out, American financial institutions? What's the future hold for the dollar as a reserve currency and fiat currency generally? And I'm going to start again with you, Brad, because I think maybe I asked you this last week at a board meeting.
Sure. Yeah, Mike, when we got together, I think back at the beginning of the year, late last year, when we were talking about prognostications for 2023, view I expressed was, dollars rolled over and it's headed lower. Now, a lot of that has to do with cyclical phenomenon, rate differentials, and investment flows. And one of the things that we've seen amplified and accelerated by the banking crisis is that rate differentials, particularly between major developed market currencies, dollar euro, dollar yen, out in the forward markets, they've converged rapidly, right? Which supports dollar softness vis-a-vis those major currencies. So some of what's going on has to do with the cycle, rate differentials, and the trajectory of policy rates. Longer term, and it gets a lot of attention, and it will be unrelenting. But there is a strong desire, certainly on the part of China, certainly Russia, who's a financial pariah, to de-dollarize as much of their trade as possible. But that is a very long-term challenge for those economies. Not to say they're not going to work at it, not going to say we won't see headlines regularly about this step or that step, this trade deal getting done in renminbi or whatever, or commodity baskets, you name it. Certainly, if you're a developing market economy, you'd love to have alternatives. You'd love to, it's not just China and Russia that would love to de-dollarize. If you're a developing market economy, you'd like alternatives. You like different places where you can engage in commerce beyond euro, yen, and dollar. But the fact of the matter is, for China's currency to emerge as a major alternative to any of the big three developed market currencies, they got 20 years to work to do in their financial system. It's a closed system. It's a system that's far from opaque. And at the end of the day, they need to open it up. They need stocks and bonds in the local markets to trade as freely and as clearly and cleanly, transparently as we have in Europe, Japan, and the United States. And they are a long, long ways away. We have a local markets business in Shanghai. We manage money for Chinese investors. We've got 80 people there. So we're on the ground, and they're in the first out of the first inning in terms of getting there, but they will continue to work at it. And it's not a near-term problem, but it's a long-term challenge, frankly, for the United States and frankly for the Eurozone and Japan to keep their financial houses in order. And it should be a bit of a shot across the bow in terms of central bank policies, financial policies, and so on.
Question for you, Dana, from Steve Millen. Is a 2% target still reasonable for the Fed with this tight labor market, or do you think they should maybe try to adjust to a slightly higher target, like 3%? Would that, what would the pros and cons of that be?
Well, I think having a target is useful, and changing it erodes your credibility. History has shown that a 2% level of inflation is optimal, not only for the US, but for many other economies. Now, the thing is that the Fed has a 2% target, but we have to remember that their objective is a flexible average inflation targeting regime. So that basically means there's a range around 2% that they're willing to allow, right? So if you have long periods of disinflation, they might allow a period of inflation that's above the target, and vice versa. Now, I would suggest that we kind of carve out this pandemic period of super inflation, right? Because that's just not normal. It was induced by both demand and supply drivers, but again, precipitated by shocks of a pandemic and then a war, and then responses to both in terms of monetary and fiscal policy. But if we carve out that segment, right, before the pandemic, we had a very long period of disinflation. We were wondering, could we get to 2%? And now we're wondering, can we get back to 2%? So I think the Fed would be going forward okay with inflation that's 2.5%, but potentially under 3% because they have this flexible regime. But again, changing the target is not a good idea, because what's it mean to raise it to 3%, or is it going to shift up to 4%? You don't know. And the whole goal of the Fed is to instill confidence in its ability to manage inflation and to control the economy and to maintain financial stability.
Agreed. Great answer. Another question from Chuck Weiss. Dana, you talked about the black and gray swans that kind of contributed to inflation, but Chuck wonders, was the injection of trillions of dollars into a supply-constrained pandemic economy really the major driver of inflation? And is that still kind of fueling it today and the source of, a lot of excess demand? What are your thoughts on that?
There were many drivers of inflation, and those drivers shifted over time. So when the pandemic hit, you saw inflation for goods because that's all people could purchase. They couldn't buy services. Meanwhile, all the factories that produce those goods were shut down around the world. And also workers were getting sick, so they couldn't transport it. You didn't have enough tankers. You didn't have enough truckers, enough port workers. And all of that backed up into inflation. So that was kind of the demand supply nexus there. But then you also had in the US massive injections of cash to households and to businesses. Now, when you have an extreme event, that's actually not a bad thing to do as well. So that was a fiscal policy, and the monetary policy was to cut rates to zero and to build up the balance sheet, the Fed's balance sheet. Now that we're roughly 3 years later, whatever money was injected was either spent or saved. Saved meaning it's been put into products that are not liquid. It's not cash. And certainly if you were on the lower end of the income spectrum, you spent that money a year and a half ago. And if you're wealthy, you put that money to use as an investment. So there's really not that much excess saving that's driving inflation right now. What is driving inflation is you still have these supply shocks, not so much from the pandemic, but from supply chain disruptions due to the war in Ukraine. So that's a supply side issue. On the demand side, consumers are demanding services. And meanwhile, you don't have enough labor. There's strong demand for labor, but not enough supply for the reasons I mentioned, mainly being the fact that you have baby boomers leaving the labor market. So again, inflation has been elevated and driven by different factors over the last 3 years. But right now, I wouldn't suggest that those cash injections that happened in the past are still influencing inflation right now.
Yeah, it's sort of baked into wage growth now too. And, with that higher wage growth that probably we all, contributed to as employers in the last year, that creates the additional spending power. So that's kind of what needs to be leaned on now, it seems like. Mike Stohler, you talk a little bit about getting into private markets. I just wanted to ask you what, we can see what's going on in the bond market every day or in public equity prices, but what's the impact on private companies, especially of some of these banking issues? Are they more significant for private companies, and does that concern you at all?
I think the bigger problem for private markets is probably inflation versus the banking crisis per se. Clearly, there's overlap. SVB, as an example, had a lot of relationships with Silicon Valley. So there were a lot of early stage companies who had concentrated exposure to the bank in various ways. But, big picture, if you take a step back, what's happened here with respect to equity or debt is financings have become more expensive, right? And that's the biggest problem for young companies with high cash burns, right, that need financing. That's been a real stress, especially for earlier stage investments. I think over the long term, we're just sort of going back to normal. I think what's very interesting is you kind of have two tiers of early stage companies, ones that raised a lot of capital at very advantageous rates right before the bottom dropped out. Those companies are in great shape and have a huge moat around them. And then the newer players that maybe got that timing wrong are incredibly disadvantaged here. So part of investing in private companies means trying to figure out who's who.
Great. Well, we are past our designated conclusion of 8 o'clock, and I want to be respectful of our guests who've given their time to us tonight. Thank you all for being here. Dana, for really setting the stage again with all the terrific data that you share with everybody, and Brad and Mike for your insights about, just what's going on in credit markets and, on the Fed and how they're thinking. And Mike, I think we've got a meeting coming up in a few minutes. We're gonna have to go over that portfolio. All right. So great to see you all, and we'll do this again soon. And really, thanks for taking the time to join us. So thanks for being here to our audience as well. We'll be back again. We don't yet have a date set, but I think we're going to talk a little bit more about the labor market soon and how much some of the pandemic-induced changes will be with us for the long term. And we also invite your questions in our comment stream or email them to us about topics that you want to hear about. We'd love to cover things that are of interest to our viewers. So thanks for joining us, and on Wisconsin.
Welcome to the University of Wisconsin-Madison, purveyor of Midwestern values. Values like a hard day's work, lending a helping hand, being a friendly neighbor, spending time with family, staying close to home, enjoying the simpler things in life, and living with integrity. It's these values that make a Badger unfailing.